I'm happy to share that Mr. Alexander Wetterling is joining us here today. He is founding partner at Stotz Investment Research. Mr. Wetterling, it's great to have you.
Pleasure to be here.
Maybe before we start with our main topics, tell us a little bit about yourself.
Yeah, so I'm originally from Sweden, and nowadays I live in Bangkok, and I've been here for about 10 years now. It was quite random that I ended up here. I did an exchange at a university here in Bangkok, and then I had a professor which I found very inspiring, who I later did an internship with at an investment bank because he had always been teaching on the side of his career. And there I work with my current now 2 business partners. So basically after my internship, they offered me to come and work for their own firm, which they were planning on setting up. And then after a couple of years, they made me a partner in the firm. So I've obviously stayed here. And we're basically doing 3 different things. The key business is we're providing investment strategies where we create asset allocation strategies, but also stock picking strategies. We have, of course, the asset allocation is global, but then with stock picking, we generally focus on Asian markets.
Mm-hmm.
And then we have a consulting business where key focus is on outsourcing CFO services. We're basically helping companies to either professionalize their business or companies that are in trouble when it comes with their finances. And we help them sort out the issues that no one else had been able to sort out before us.
Mm-hmm.
And then the third part is an academy or training arm, where we, for example, provide valuation masterclass, but also other finance training. So that's a bit about me.
Sounds great. Thank you very much for introducing yourself. The first topic we will talk about today is actually your allocation strategies. We will talk about global asset allocation. And you shared with me that you currently maintain a 25% allocation, or you recommend a 25% allocation to US equities. And as we all know, 2023, the US experienced a year of notable disinflation, immaculate disinflation. And there's optimism that the recent economic growth will not lead to inflationary pressure, so that the immaculate disinflation can continue this year. In March, for example, we did see that non-inflationary expansion of the labor market, very strong job growth, average hourly earnings were in line with expectations, participation rate ticked up. Have you recently increased your allocation to US equities given this very favorable environment and the optimism for a soft landing? And what factors would prompt you to increase exposure further if that's an option?
So to start with the negative part about the US, I mean, I'm concerned about the high debt levels. I'm also not convinced that the average American feels that the economy is as good as the economic data wants to tell us. The recent rally in oil price could maybe also lead to inflation returning. And I think even the prospects of inflation returning might mean that the interest rates will be kept at a high level for longer, meaning it might take a longer time for the Fed to start cutting. With that said, I mean, the US economy is still the world's leading economy, and it's home to the most innovative and the biggest companies in the world. And I don't see that change anytime, in the next couple of years. We've had this 25% target allocation to the US since August last year. So we've been in it for, a bit more than 6 months. And just to mention, it's like when we went in 25% in the US was also when we raised our overall equity allocation to 85% from 65%. So basically we saw, okay, we think equity overall is attractive, and that's when we weighted up the US. Part of that decision is US is dominant in financial markets, and the US dollar, is the most powerful currency in the world. And that also means that you typically want to have some exposure to the US. You don't want to overweight it too much.
Absolutely.
Given that,
Sorry.
no worries. I mean, another part just to highlight with this 25% is it's 25% in an 85% overall equity allocation. So effectively, we're allocating 30% of our equity to the US.
Okay.
While if you look like an index like MSCI All Country World, US is over 60%. So we're basically not very heavy in the US. We're more in it because we feel like developed markets is probably going to outperform emerging markets. And US is such a dominant market and US dollar is so important. So if things go a little bit up and down, US is probably going to be at least better than emerging markets. The final point I would make about this as well is we reevaluate our target allocations every 3 months. So while we might, overweight or keep a target allocation for, a year or longer, we reconsider it every 3 months. So sometimes we just, go into a certain market or asset class for 3 months, and then after 3 months, we reduce it to a much lower weight.
Okay, that makes sense. So when you increased your overall exposure to equities, did you proportionately increase your exposure to each sort of equity class?
So when we increased to 85% equity, it means then we have 3 other allocations. One is commodities, one is global bonds, and one is gold. So then we're basically holding 5% bonds, 5% gold, 5% commodities.
Yeah.
Within equity, we then overweighted developed markets. So we added like most of the allocation is to US, Japan, and developed Europe.
Okay. And I also see that you currently have a 25% exposure to Japanese equities. And we know the Bank of Japan has been a lot of focus has been on the Bank of Japan in the past few months. And what I would like to know is whether the decision of the BOJ to allow yields on Japanese bonds to rise, so sort of that slow exit out of yield curve control, whether that has affected your view of Japan as an investment destination.
So first of all, we decided to overweight Japan in March 2023 and has been overweight since. So that means we've been in Japan or overweighted Japan for a bit more than a year. And back then, initially, when we went into Japan, we didn't consider the BOJ actions too much because we felt like, number one, at some point they will start to normalize. But we also felt that's not going to happen right now. We're getting closer, but it's not going to happen right now. And we also were like, even if it starts to normalize, we didn't think that it necessarily had to have a massive negative impact on Japanese equities. So yeah, it wasn't like any of the deciding factors what BOJ did. What we saw was that inflation was rising, and I think it was around 4% when we went in. And yeah, as you also know very well, I mean, BOJ has been fighting deflation for over a decade. So to see inflation in Japan was something, very new. We could also see that there was negotiations with the big unions in Japan, and probably we would see historical wage hikes. And we saw that could, push inflations possibly even higher.
Right.
At the same time, Japanese companies held back then and, still are holding a lot of cash. So we looked at it at an aggregate level, and companies sat on more than $2 trillion in cash. And that's almost half of the Japanese GDP.
Wow.
So when we saw the rising inflation, meaning that if you just sit on cash and don't do anything with them, you're losing purchasing power. And also you had started to see the Tokyo Stock Exchange really push hard on various measures for capital efficiency. We thought that maybe companies now going to start using their cash. So for example, they invest more, spend more on capex, or if they don't have a lot of projects to invest in, maybe they do share buybacks and so on. So taking all those things into consideration, we thought that now might finally be the time for Japan to revive itself. I mean, it's been more or less a dead market for a very long time.
Mm-hmm.
And I think, March 2023, we basically got into Japan pretty much right before it started to really take off. I don't claim that we have a magic timing thing, but the timing ended up to be really, really good. And I think that's, for sure, in the past year, I think that's the best call we've done.
Yeah, absolutely. And I mean, what you could say at the moment is that the BOJ has this historic chance to get out of deflation. And I was wondering, because we have seen significant weakness in the Japanese yen over the past few weeks, and I was wondering whether that is something that the BOJ is potentially worried about, because I feel like the number one focus of the BOJ is getting out of deflation. So maybe they don't even care that the yen is weak, because maybe, that should help get out of deflation. So what's your perspective on that?
Speculations at least is that, at some point, if the Japanese yen weakens too much, that the BOJ will intervene for it to not, go wild and crazy. Given that, they went from negative interest rates to at least positive, 0 to 0.1 recently, it might be that they will try to say, we are different now, and they won't intervene as quickly. But it's tough. I don't think BOJ will, be rash in their changes. I think they will do it very, very slowly. So we're probably going to continue to see a lot of support from, buying equities, buying up whatever they need to, and to keep rates around 0 for quite some time. Also, inflation seems to have peaked in Japan. Yeah, if it comes down further, and let's say you're right that deflation is going to be the most critical thing for them to fight, they will need to stay at 0 or even go negative again.
Absolutely.
So we'll see.
We talked a little bit about your exposure to the United States at the beginning, and I'm curious because you have a 25% exposure to European equities, to developed Europe, I think at least. And if you compare European equities to US equities at the moment, they seem quite cheap, which makes sense because we didn't see immaculate disinflation in Europe. The economy is much weaker. We didn't have that AI-driven market exuberance in the European equity market. But when you take a look at the difference in valuation between European equities and US equities, do you look at Europe more from the perspective that it could be a value trap, or do you think increasing your exposure to Europe, decreasing your exposure to the US is a good strategy?
So to go back a little bit in history again, we did overweight developed Europe in March 2023, the same as Japan. So far we can say that Japan was a much more successful call than overweighting Europe back then.
Mm-hmm.
But it was mainly that we saw that we preferred developed markets over emerging markets. I think that the assessment you just made right now is very good with regards to Europe. It's a cheap market, but there hasn't really been any catalysts.
Mm-hmm.
Also, when putting it in relation to the US, the challenges are very different. I would say, especially demographics would be one of the big things that differs a lot between the US and Europe. Europe is more similar to, let's say, Japan, while US still has a lot of young immigration, helping them to keep the labor force relatively big. So the reason we overweight Europe, besides just being developed markets, is because we find European companies, they are very resilient in general, because they used to operate in a sluggish environment, a lot of regulation, growth going up and down, meaning it's not straight up for European companies, but rather it's a fight to survive. Mm-hmm. So I would say very resilient companies. The other part, if we would see, which we felt a few times, but it hasn't really played out yet, is if China reopen, there's a lot of European companies that could benefit if they reopen, because European companies are leaders in industrial automation. But the other part, let's say that there won't be a strong China recovery this time. We have the China-US tensions, which might mean, reshoring, or that at least production moves out of China. And there, I think, Europe is really good at manufacturing and automation, so they could actually be a place for global companies to produce, but at least European companies would take home production to their home markets. Mm-hmm. The final point I would make about developed Europe is that everyone more or less has a negative outlook on Europe. Yeah. So we feel like it can maybe not get that much worse. So any surprises that are a bit positive could maybe be a catalyst and really lead to a re-rating.
Absolutely, that's a great point. And your allocation also includes a 5% exposure to global bonds. And reading your research, I saw that you're talking about declining inflation across developed markets. You talk about the expectation of peaking interest rates. But this environment, or in general, amid macroeconomic uncertainty, when you're in this environment of declining inflation and falling interest rates, bonds is sort of the asset class that can really benefit from that. And I mean, the debate in the US, for example, all this time has been, will we get a soft landing? Will we get a hard landing? We're kind of back to no landing at the moment, but getting a soft landing or a hard landing, both outcomes are pretty positive for bonds. So many people have been quite optimistic that 2024 will be a positive year for bonds. So I'm wondering, why did you decide on such a modest allocation to bonds of only 5%, especially when global interest rates are expected to decrease this year?
So again, I think you made a really good assessment of the current situations and what looks attractive about bonds. To us, the main reason we allocate to bonds in our strategies is not so much that we expect to make massive returns on them. Mm-hmm. So it's more about we're expecting, if we weight bonds heavy, it's more about capital protection than that we see it's going to be, a great trade. I do, however, think that at a time not too far from now, meaning maybe 3 to 12 months, within that range, that there will be a trade to be made in bonds. And that's for the reasons you mentioned. Yeah. At some point, Fed and other big central banks will start lowering rates, and then bonds should do well. Though, it's hard to get timing right. Mm-hmm. I mean, just look, as soon as there is some guy from the Fed saying something about rate cuts and so on. If you look at the probabilities or how traders position themselves, it's very big swings on when they think, the cut is going to come. So the timing is really, really hard, but I do think when the cutting begins, I think bonds are going to go up. But I also think you need to remember that if the economy remains strong or inflation starts ticking up again, this bond trade is likely to be delayed as well, because the Fed is probably going to keep rates high. So, I mean, our 5% allocation to bonds right now just means that we think equity will outperform bonds. So it's not saying that bonds might not be attractive, but we are saying at the moment, equity is what we think going to outperform.
Absolutely. And I mean, bonds have been so incredibly volatile, as you already pointed out, because the data has been so strong. I mean, when we got the Fed pivot last year, really caused a rally in bonds, but then 2024 came, and the story of this year has only been strong inflation data, strong economic data. And I think, yeah, now in the US, it at least comes down to considering whether that inflation data from January, February is only a temporary blip, or whether it is really the case that the progress we have made in bringing inflation down has now stalled. And I think, I mean, we'll get the hint for that in around 45 minutes. The CPI report will be released. But yeah, you're right. It's just been incredibly volatile. So very hard to time the right moment to really.
I think maybe we need to look at the expectations, before that meeting or before that announcement. And then when the announcement has been made, to see how it switches, assuming though that there is anything that is not as expected. If it's as expected, it's probably not gonna happen too much in how they position themselves. But if there's any tiny surprise, you'll probably see that the expectations of when the cut will start happening will move very quickly.
Yeah, that's right. And I think we really have to potentially for a relief rally with the inflation data, because if it is quite weak, then sort of that will be the green light, because that's what the Fed has been betting on, essentially. Talking a little bit, I would like to talk a little more about Asian equity markets. I saw that the fund, your fund, Thales FVMR Asia Pacific, excluding Japan, excluding China, was recently launched in Thailand, and that Stotz Investment Research is a research provider to Thales. Could you explain what FVMR stands for and how it represents your methodology?
Yeah, so FVMR is an abbreviation of fundamentals, valuation, momentum, and risk. So these are the 4 elements of return. We use our FVMR framework when we create investment strategies, no matter if it's stocks, bonds, ETFs, or mutual funds. So it's our way to assess if an asset is attractive or not. We say that the framework is quantamental, and what we mean about that is we use both quantitative research but also fundamental research. So just to maybe make it a bit more tangible and explain, how we look at things is when we create an investment strategy, we'd start off with creating the investment universe. So in this case, it's ETFs, and it's in Asia Pacific, and we exclude Japan and China. So in total, we invest in 9 different countries and just buy the country ETFs. If it's a stock portfolio, we might say that it's the Thai equity markets, or it's China A shares, or it's Asia X Japan or ASEAN or something like that. So that's the first thing. And then we're going to construct the portfolio we're going to hold. And how we do that is we're going to assess the attractiveness of each asset in the universe on these 4 elements. So we look at fundamentals, depending on if we're looking at stocks or if we look at the ETFs. If we talk about this fund, we would look at ETFs. So then we do a bottom-up analysis of the companies that's listed in each market, and that's to determine operational, financial, and competitive performance. We may consider measures like return on equity, return on assets, or look at different margins. Then when it comes to the valuation, we typically look at both absolute and relative valuation. So it might be, PE or PEG ratio, or it might be DCFs. And we then just try to determine, relative to the investment universe, is this asset over or undervalued, and to what degree? Then what might, be not that common for at least fundamental investors is that we also consider momentum. We look at both earnings and price direction. So we measure price, how much they go up, how much they go down, so purely technical. And then we also look at, what's happening with earnings growth. Is it rising, falling, and so on? Finally, then with risk, similar to momentum, we look at both price risk and fundamental risk. So example of price risk is to look at, let's say, volatility or maximum drawdown or something like that. And fundamental risk might be debt levels. Lastly, then in addition to this FEMR, when we talk about ETF strategies that regards to Asia or countries, we would also then do fundamental research to evaluate economic and political risk and trends, and then also look at traditional economic factors like GDP growth, inflation, what's happening with the exchange rate, stuff like that.
Yeah, I must say this the abbreviation and the term FVMR, I think it's great. It's a great research methodology, and yeah, I'm a big fan of creating a fund that sort of the name of the fund incorporates sort of your fundamentals and how you conduct research and how you conduct business. So I think that's a very creative way. But the fund is called ex-China, and to my knowledge, it used to be called only ex-Japan. So recently you did decide to exclude China from your fund. And I'm interested, what were the driving forces behind that decision, and how do you currently evaluate China from an investment perspective?
So just to clarify, this fund is recently launched, so it has always been Asia Pacific, ex-Japan, and ex-China.
Okay, always.
Yeah, but if we talk about traditionally when looking at Asia or Asia Pacific, investors have for a very long time been able to access Asia ex-Japan or Asia Pacific ex-Japan, and the reason Japan was excluded was that it was so dominant back in the days. So then they said, Japan market is so big and so liquid, so let's trade Japan separately from Asia or Asia Pacific. And nowadays, what we propose or mean is that China is very, very big. It's the dominating market in the Asia Pacific ex-Japan index and in the emerging markets index. So the main reason we exclude China is just we say China, like Japan, should be treated separately. When you invest in Asia, you should invest Asia as a group or Asia Pacific as a group, and then China and Japan. So split it into three rather than just buy all of Asia. And that's to be able to, hopefully in a bigger portfolio, be able to tweak the risk return profiles better.
Yes, that makes sense. And I would like to talk about China a little more in detail, because as most of us probably know, one of the significant driving forces of China's economy has been its transition from a state plan to a market-driven model. But some might argue the benefits that have been gained from that transition have plateaued. And then you take a look at China's industrialization boom, for example, that has played a crucial role in expanding its economy. The ING's Greater China chief economist, Mr. Lin Zong, recently suggested that China's manufacturing sector has matured now, so there is not that much growth opportunity coming from that sector. Do you agree with that valuation? And what are the potential sources of growth that you foresee for China in the future?
So I think, first of all, I mean, in the past couple of decades, China has done something remarkable, and they should definitely not be underestimated.
Absolutely.
I think if we look long term, it will boil down to politics. So if China continues down the path of 1984 style surveillance and totalitarianism, I think they will fail. Capitalism and freedom are ultimately what drives progress. And that's maybe something we should remind the West of too. Regarding the manufacturing, I mean, China is no longer super cheap to produce in. What I think is more important is the US-China conflict. That's going to lead and have already started to lead to relocation of manufacturing. I also see, a lot of wealthy Chinese leaving China. We can see a lot of Chinese moving to, for example, Thailand, where a lot of the private schools here, 70% or more of their foreign students are Chinese. So I think long term, if China doesn't become more free within the country, I don't think it will be as relevant or important as it is today. Also partly because their demographics will, bite them in the next few decades. If we look a bit more short term, I would say, probably getting close to a bottom in Chinese stocks might be a quite decent rebound. But also remember, as a global investor, US will do what it can to regulate or reduce capital inflows into China. So, it might be hard to access it, and the rebound might not be that strong if it's only domestically driven.
Absolutely. I mean, China is a topic that we could probably talk about for hours, but then we are running short on time. So the last question that I would like to ask you is about ESG, and I would like to know how you integrate ESG factors into your investment analysis and decision-making process.
So when we talk about ESG in the current form, I don't integrate them at all, and I don't think anyone should do it. The G, which stands for governance, it's very important to consider when you invest in a company, but that has been considered way before we had this current ESG movement. So just as I go on now, when I say ESG, I primarily talk about the E and the S, because I think the governance part is very important. So to start off with, why does company exist? Companies exist to make profit. Milton Friedman, he said, the business of business is business. I even put this quote on a baseball cap when I was in New York during my university time. I might even have it somewhere in a shelf or something still, but I love that quote. And I think it's very important to remember. So businesses exist to make profit. We need democratically elected and competent politicians to set policies and the legal framework that addresses these ESG issues. That responsibility should not be put on corporations and CEOs and so on, because they're not elected officials. This is a job for politicians. So don't push your responsibility to someone else, and someone who is not driven to do good necessarily, but where the focus is profit. They might take shortcuts, or they might sometimes be an unethical individual running a company. And that's why we should have government. So in my view, and I think there's a lot of evidence for it, the ESG movement has just become about virtue signaling. So people try to say that they're good rather than actually working for making the world a better place. So they say they're making the world a better place, but it's just talk. There is not really much action to do it.
Mm-hmm.
The other part, I mean, if we go in and talk a little bit about the complexities, it's very hard to evaluate ESG impact. And also when it comes to the E and S, not so much with the G, it comes down to personal values. So let's say if you're an environmentalist, or if you're a socialist, or if you're a capitalist, or if you are a Christian, or you're a Muslim, or you're a Jew, or a Buddhist, or a Hindu, you will have different values. And that means you cannot say that there is a coherent ESG values. And that's my other issue with this movement, is that they're saying that they, embrace diversity, but instead they're force feeding us some woke values and say everyone thinks the same. So, in the end, you need to consider that it's your values your investments should reflect. And it's not going to be, some woke ESG agenda you follow, unless that is matching your actual values. So that's fine if you actually think that's right. But at the same time, if someone just want to invest based on maximizing their returns, that's also fine. So just make sure that you're finding a manager or investing, with what aligns with your moral standards and also following the law.
Absolutely. Well, Mr. Wetterling, thank you very much for your time today and for your insight. I wish we could talk a little longer, but unfortunately, that's not going to be possible today. But maybe we can meet again at some point in the future. And yeah, discuss how the investment horizon changed, whether any of your strategies changed, talk a little bit about the US economic data that was released if you're interested. I think that would be great.
Thank you very much. It's been a true pleasure.
Thank you very much. Have a great rest of your day, or your evening, I guess. There's not much left. And yeah, talk to you again soon.
Thank you. Take care.
Bye-bye.